In our last session, I introduced on consolidation, and we did one question for June 2011. Now let's try another question. May 2017, question 1. May 2017, question 1. And we are told that the following is a summary of financial statement relating to A Limited, B Limited, C Limited, and D Limited for the financial year ended that 1st March 2017. So you are given the income statement, then you are given the statement of financial position. Now, whenever you get a question on consolidation, the first step is to determine whether the financial year ends and then also identify the group structure. For example, in this case, we don't know which is a subsidiary, which one is a sub-subsidiary, which is an associate. So first of all, identify the group structure. Now let's go to the additional information. Number 1, A Limited acquired 80% of the share capital in B Limited on 1st April 2014. A Limited acquired 80% in shares in B Limited. When was that? On 1st April 2014. And the year ends on that 1st March 2017. So that means B has been a subsidiary for how many years? Then let's go to number 2. B Limited acquired 75% of the share capital in C Limited. B acquired 75% in C Limited on 1st April 2015. How many years to the end? How many years? So let's go to number 3. Number 3, B Limited also acquired 40% of shares in D. So B also acquired 40% shares in D. So that means A is the parent, B is the subsidiary, and the non-controlling interest in A is 20%. Then A, this is a subsidiary, therefore C is a sub-subsidiary because control is 75%. So how does A control C? It's just 80% of 75%, of which that's 60%. Then B also acquired D, 40%. So that means D is an associate to B. Therefore, how does A control D? A has a significant influence in D through B, and that is 80% or 40%, and that's 2%. So therefore, we have a subsidiary, a sub-subsidiary, and an associate. We say that we don't consolidate associate. Let's go back now to note number 1. A Limited acquired 80% of the share capital in B Limited on 1st April 2014, when the retained profit of B Limited were 100 million. That's the pre-acquisition retained earning. An item of plant in B Limited had a fair value of 20 million above its carrying amount. Above its carrying amount. Now that's what we call revaluation. We had revaluation of plant, and it has a revaluation of 20 million. And depreciation is at the rate of 20% per annum. There was no other reserves other than the share premium. So we revalue the item at 20, then we provide depreciation. The depreciation rate is 20% per annum. You take 20% of 20, of which you'll get 4. That 4 is what you take to the income statement as depreciation charge for the year. Then, if the depreciation is 4 per annum, and we acquired B 3 years ago, so the accumulated depreciation will be 12. This is what you take to the balance sheet. Number 2, B Limited acquired 75% of the share capital in C Limited on 1st April 2015, when the retained profit of C Limited were 100 million. Land belonging to C had a fair value of 50 million above its carrying amount. So we had also revaluation in C. For land, the revaluation gain was 50. Land does not depreciate, so therefore it cannot provide a depreciation. And number 3, B Limited also acquired 40% shares in D Limited on 1st April 2015, when the retained profits of D Limited were 150 million. So that's an associate, you don't account for associate. Number 4, the group uses partial goodwill method, and even though no impairment was reported in previous year, half of the goodwill has been reported impaired in the current year for B Limited and C Limited. The goodwill of D Limited was not impaired. So we compute goodwill on acquisition. And in this case, we compute the goodwill on investee. In C, it's 600, but B invested in C for 600. We assume the parent contributed 80%. So 80% of that one is 480. Then you raise net assets acquired. Now for the net asset acquired, we say that you look at the equity. To the equity, we have ordinary share capital. How much is the ordinary share capital? So for B, it's 500. We have 400. Then we have share premium. Share premium, we have 300. We have 250. Then we have retained earnings. For retained earnings, so they take pre-acquisition. Note number 1, A Limited acquired 80% of share capital in B Limited on 1st April 2014, when the retained profit of B was 100. Number 2, B Limited acquired 75% of the share capital in C Limited on 1st April 2015, when the retained profit of C was 100. Then we had revaluation. For revaluation, B revalued its item of plant by 20, so we factor that 20. Then C revalued its land by 50. But the revaluation of C will be captured by B. We only capture the revaluation itself, it was pre-acquisition for subsidiary. So therefore, we will not incorporate this revaluation of 50. So give me the total, 5, 6, 7, 9. That's 920. And then we are controlling B 80%. 4, 5, 6, 7, 750. And then we are controlling 60%. Give me that. Seven, that's 6. So we can have goodwill. So when you get 64, 450. So we have a goodwill of that. Note number 4, you are told that the group uses the partial goodwill method, and even though no impairment was reported in previous years, half of the goodwill has been reported impaired in the current year for B and C Limited. The goodwill for D was not impaired. So there was an impairment loss on goodwill, half of it. So impairment loss, half of it. So that's 50%. That one will be that too. Therefore, our net goodwill will be an amount of that too. 50% of this is 15. So the net will be 15. So therefore, how much is our impairment loss to the income statement? You have this, that too, and then you add 15. That you get 47. Now 47 is what you take to the income statement as the impairment charge for the year. Let's go to note number 5. Note number 5. Intercompany sales were as follows during the year. So number 5, we have intergroup sales. And we have the seller and the buyer. C sold to B. C sold to B. The selling price was 200. Then they made a margin of 50%. So to get the unrealized profit, you take 50% of 200. Then you are told that we have balance in stock of 50%. How much the unrealized profit? That's 150%, you get 50. Then also we had Sarah, B sold to A. B sold goods to A. The selling price was 250. They made a profit margin of 40%. So unrealized profit, you take 40% of 250. Then you multiply by the balance in stock was 25%. That's 100 to get an amount of 40. Sorry, 25. 25% of 100 is 25. Then B sold to D. B sold to D. D is an associate. We say that we don't consolidate associate. We account for it using the equity method. So therefore, our total unrealized profit, we have 50. Then we have 25. The total is 75. So how do we treat this 75? So we say that one unrealized profit, you add it to cost of sales, you eliminate from the closing stock. Then we have intergroup balances, intergroup sales. I said that for the intergroup sales, we had 200, then you add 250, the total is 450. We say that you eliminate from both sales and cost of sales. Let's go to number 6. Number 6. Intercompany balances were as follows. Intergroup balances due from B to C. B to C, it's an amount of 40. A to B, we have a balance of 50. And then we have due from D to B. D to B, that's a transaction between a parent and an associate. We don't consolidate that. So intergroup is 90. See that for the intergroup balances, we eliminate from both account receivable and account payables. Required. Consolidated income statement for the year ended that 1st March 2017. And then number B, consolidated statement of financial position as at that 1st March 2017. So consolidate that. So the parent company is A, so it's A group. Consolidated income statement. For the year ended 31st of March 2017. So our shillings are in millions. We have revenue. You raise cost of sales, and that's how you get gross profit. So you have 1,200. You add 850. You add 600. Then cost of sale, you have 650. You add 450. You add 320. Then you add 75. You also add 4. And then you eliminate 450. That's 18. 2650 minus 450, you get 2200. 650, that's 11. 11, you get 1420. 1420, you get 1495. 1495, you add 4. 1499. You minus 450. You get 1049, right? 1049. Give me the gross profit. That's 1051. 1151. So that's our gross profit. Now, once we have the gross profit, we also have other incomes. Other incomes. And for other incomes, we have 50. You add 29.5. Then you deduct. So can you confirm whether there was any payment of dividend? So who do you pay dividends to? Yeah. So you can. And for intergroup transaction, let's eliminate that. How much dividend did B paid? B paid 60. If B paid 60, 80% will go to A. So that means it was included as part of other income in A. So 60, 80%. Then C paid a dividend of 10. C paid to B 75%. Plus also D, it's an associate, paid a dividend of 50. 40% paid to B. So it's already included in 29, 40%. Now give me other income not within the group. Get an amount of? Let's go to the expenses. For expenses, we have distribution cost. Then we also have administrative expenses. Then we have finance cost. And then you factor in impairment loss. For distribution cost, we had 120 plus 70 plus 90. That's 210, you get to 80. Then admin expenses, we have 180. You add 80, that's 260. You add 120, that's 300, you get 380. Then we have finance cost, 20 plus 10 plus 30, that's 60. Then we had impairment loss. Impairment loss, that's 2 plus 15, you had 47. So give me the profit before tax. We got an amount of 388. Once we have the profit before tax, now we have the tax expense. And for the tax expense, we had income tax expense. We have 60 plus 80 plus 12. That's 152. Then you get profit after tax. You get an amount of 236. Now, once you get the profit after tax, we had an associate. How do you account for associate? Once you have the profit after tax under other comprehensive income, associate is a long-term investment. Therefore, its profit will go to other comprehensive income. So you add associate share of profit after tax. Remember, in this case, it's A who is consolidating. So therefore, he will take 80% of 40, which is that 2%. Take that 2% of profit after tax of the associate, and that's D, and they made a profit of 100. So therefore, you add that too. So therefore, how much is our total profit? You get 268. Good. You can also show attributable to, but it's not a must, we have to show that. Let's just present the balance sheet. So how do we present the balance sheet? So the statement of financial position, you still consolidate the subsidiary and sub-subsidiary. You don't consider D. So A group, consolidated statement of financial position as at 31st of March, 2017. So our shillings are in millions. So we start with the assets. Non-current assets. So to the non-current assets, we have PPE. PPE, we have 1,400. You add 800. You add 1,200. You add 20, you add 50, you minus 12. Give me that. That for 458. Then you also have intangible assets. For the intangible assets, we have 250. You add 180. You add 200. 4, 5. Get 630. Then investment in B, investment in C, that one will be replaced by goodwill. So you show amount of goodwill. And goodwill for B, we had 64. For C, we had 30. Then half of that was considered impaired. So how much will be our net goodwill? Our net goodwill will be 47. Because if impaired half, that means the other half is our net goodwill. Then investment in D. This is an associate. You see that for associate, we account for it using the equity method. So investment in associate. How do we recognize that? So we'll come back to that. We'll come back to that. Also, we have available for sale financial asset. 50 plus 30, you get 80. Let's go to the current assets. So under the current assets, we have inventory. We have trade receivables. We have bank and cash. So for inventory, you take 100. You add 80. You add 90. You deduct 75. Trade receivable, you take 160. You add 140. You add 150. Then you eliminate the intergroup balances, of which we had 90. 75 from inventory was unrealized profit. Then we have bank and cash. 40. You add 60. You add that. This is 130. Give me the inventory. 180. 195. That is 350 minus 450 minus 90, you get? You get 360. Now let's go to the equity and liabilities. To the equity and liabilities, we have ordinary share capital. We also have share premium. We also have available for sale reserves. That means there was a revaluation reserve. Then we have retained profits. Then you also factor in the non-controlling interest. You say that for the ordinary share capital, you only take for the parent, you don't consolidate ordinary share capital. We have 1,000, as well as the share premium, you only take for the parent, 400. For other reserves, you only take for the parent, and then you add the post-acquisition changes in the net asset. So for example, for available for sale, we take 10. That's for the parent. Then B has a revaluation reserve of 5. But the parent is controlling. We are saying that you take the investee share in their post-acquisition reserves. So you take 5, and then A is controlling B 80%. So you take 80% of that 5, which is 4. You get an amount of 14. We see that for retained profits and NCI, you can leave them, because for you to get it correctly, all your adjustments up to this point, including the goodwill, as well as the argument, should be clear. For example, in this case, C sold good to B. If it was B who sold to C, the argument will change. So in that case, for you to get the retained profit correctly and the NCI, your argument should be also should be correct. So you can ignore that. Let's go to the non-current liabilities. To the non-current liabilities, we have 10% loan stock. Also, we have deferred tax. For the loan stock, you take 200. You have 100 and you have 300, you get 600. For deferred tax, we have 40. You add 30, you add 20, that's 90. And then we have current liability. For the current liabilities, you have trade payables. We also have bank loan. And then we have the current tax. So for trade payable, we have 280. We have 425.5. We have 260. Then you deduct 90. For the bank loan, we have 200, 400. Then you add 150. Then for the current tax, we have 80 plus 100 plus 54. That's 234. That's 750. Trade paper is how much? Sorry? 875 point. Simple as that. So I want to show you on how to account for investment in associate using the equity method. Let me show you that. Investment in associate. So how do we account for investment in associate? We say that under equity method, you take the purchase consideration or the cost of investment, purchase consideration. And the purchase consideration B acquired D. So you go to the non-current assets where you have investment in D. It's 400. You multiply by 80%. B paid D 400, but is the parent who is consolidating. So the parent contributed 80% of that, of which you get 320. Then you add post-acquisition changes in net asset. And for the net asset, we see that the most asset which changes, or the net asset which changes, is the retained earnings. The parent controls the associate, that 2%. So you take that 2%, you take the retained earnings of the associate, you have a retained profit of 310. You minus, we are looking at the post-acquisition changes. So for post-acquisition changes, you take the balance up to date, then deduct the retained earnings at the rate of acquisition. And note number 3, you are told that B Limited also acquired 40% of D on 1st April 2015, where the retained profit of D was 150. So 160 times 32% you get. $51.2. 51.2. Give me the total. We get 371.2. So investment in associate, the amount of 371.2. Good. So that's how you present that. I wanted to give you some few minutes, just look at that before I do another illustration.